In one case, the federal government forced two companies to hand back $1.8 billion, not because they were rude to customers, not because their prices were too high, because what they charged you broke a specific federal law. That's one case. There are at least 6 more charges just like it, happening right now, to people who have no idea they're illegal. A fee on your bill, a fee at the bank, a fee in your parents' nursing home paperwork. 7 of them, total. And statistically, you've already paid at least one. You might assume this is only about banks or debt collectors, so if neither applies, you tune out. But one of these 7 touches your Medicare bill, one touches a funeral, one touches a parent's nursing home admission. Stay with me. Quick note. I'm not a lawyer or your advisor, and this isn't personal advice. It's the briefing that helps you ask the right question before you sign or pay. If you've ever paid a bill online or over the phone to a collection agency and noticed an extra charge tacked onto the payment itself, this first one is yours. It's usually called a convenience fee, a processing fee, sometimes a technology fee. $5 to $15 added on top of what you already owe, just for the privilege of paying it a certain way. Here's the rule most collectors are hoping you never learn. Under federal law, a debt collector can only charge a fee if 2 things are both true. It has to be spelled out in the original agreement that created the debt in the first place, and it has to be legal under whatever state law applies. Most of these fees fail the first test alone. They were never in your original agreement. They were added later, quietly, at the payment screen. The Consumer Financial Protection Bureau said this outright in 2022. If the fee wasn't authorized when the debt was created, charging it is a violation of federal debt collection law. Full stop. And this one doesn't have a clock. It's not a one-time charge you pay and move past. If you're on autopay, it renews every single month quietly for as long as the debt collector can get away with it. A small number that never stops compounding because nobody ever stopped to ask if it was legal in the first place. The fix costs you nothing and takes 1 sentence. Before you pay a collector by phone or online, ask them directly. Was this fee disclosed in my original credit agreement? If they can't answer that clearly, you have the right to ask for a fee-free payment method instead, and most of the time, one exists. They just don't lead with it. If you've ever caught a convenience fee like this on a bill, tell me in the comments what it was called. Collectors are creative with the wording, and seeing the pattern helps everyone watching catch theirs. If your Social Security, SSI, or VA benefit lands in your account by direct deposit, this next one applies to you automatically, whether you've ever had a problem with your bank or not. Here's the mechanism. If a garnishment order ever hits your account, a creditor trying to collect a judgment, federal law requires your bank to look at the last 2 months of deposits and automatically protect whatever portion came from a federal benefit. Social Security, SSI, VA, protected. The bank doesn't need you to fill out a form. It doesn't need you to ask. It's supposed to happen the moment the order arrives. What's not supposed to happen is what happens next at some banks. They charge you a garnishment processing fee, $75 to $150, and take it directly out of that same protected amount. The one pool of money the law says cannot be touched is exactly where the fee comes from. The irony is almost the whole story. The protection is automatic. The violation happens on the exact money the automatic protection was built to guard. Some banks go further and freeze the entire account first, protected portion included, until you show up in person to sort it out, which, for a lot of people in this age group, means missed bill payments and overdraft cascades on money that was never legally at risk in the first place. If this ever happens to you, you don't need a lawyer to fix it. You call the bank, you say the words, "This is a federal benefit account under 31 CFR Part 212, and you ask them to release the protected amount and reverse the fee. Banks that get that phrase from a customer tend to move a lot faster than banks that just get, "Please help me." Who here has ever had an account frozen or a fee taken out of a Social Security deposit? Put it in the comments. This is one of the most common complaints filed with federal banking regulators, and most people never connect it to this specific rule. This next one lands during the 1 week most families aren't in any state to question a bill, planning a funeral. Here's what happens. A family decides to buy a casket or an urn somewhere other than the funeral home, often for a fraction of what the home would charge for the same item. And then, On the final invoice, a new line appears. A handling fee, an acceptance fee, sometimes just third-party item fee. $100 to $500 or more, just for accepting something the family already paid for elsewhere. The Federal Trade Commission's funeral rule makes this explicit. In writing, a funeral home is required to accept a casket or urn a family bought from a third party, and it cannot charge an extra fee for doing so, not a smaller fee. No fee. The reason this one survives so well isn't secrecy, it's timing. Nobody negotiates a bill while they're grieving. The fee gets folded into a stack of other charges, presented at the worst possible moment to read the fine print, and paid without a second look. There's a one-sentence way to head this off before it ever appears. When you call to ask about pricing, ask the funeral home directly whether they charge a fee for accepting an outside casket or urn. Under the same FTC rule, they're required to give you an itemized general price list on request, and reading that list before you're standing in a grief-stricken decision is the version of this where you never see the fee at all. If you've planned a funeral for someone and caught a fee like this, or didn't catch it until later, you're not alone, and it's worth naming below for anyone about to go through the same thing. Remember the number from the very start of this video? $1.8 billion, forced back by the federal government. This is where that number comes from, and it's actually two fees at once, running the same playbook under two different names. The first is debt settlement. A company promises to negotiate your debts down and asks for an enrollment fee or a setup fee before they do anything. Under the FTC's telemarketing sales rule, that's illegal. A debt settlement company is not allowed to collect a fee until it has actually settled or changed the terms of a specific debt, and you've made at least one payment under the new terms. Not, we're working on it. Not, we've started the process. Settled first. Paid first. Fee only after. The second is credit repair. Different company, same shape. They promise to fix your credit score and ask for money up front. Enrollment, processing, the first month. Under the Credit Repair Organizations Act, that's illegal too, with no exception for how the fee is labeled. A credit repair company cannot charge you anything until the promised work is actually done. Two different federal laws. Same broken promise. Pay now, results maybe. In December 2024, the government's enforcement action against two of the largest companies running exactly this model returned that $1.8 billion to 4.3 million people, most of whom never knew the fee itself was the violation, not just a bad deal. $300 to $1,000 or more gone before a single debt was settled or a single credit score moved. Here's the question that ends both scripts fast. Ask the company directly, will I owe you anything before results are delivered? If the honest answer is yes, walk away. That answer alone tells you you're talking to the fee, not the fix. If you've ever sat across from an admissions coordinator at a nursing home, signing a stack of papers on the worst day of your family's year, pay close attention to this one. It's the largest single number in this entire video. Nancy's mother needed placement fast, straight from a hospital bed to a nursing facility, the kind of transfer that happens in hours, not weeks. At the front desk, an admissions coordinator slid a folder across the counter and pointed to a signature line. Just a formality, she said. We need someone listed as the responsible party. Nancy signed where she was told. She had a parent to get settled and a job to get back to. She didn't read every page. 8 months later, a bill arrived. Not addressed to her mother's estate, not addressed to Medicaid. Addressed to Nancy, personally, for her mother's entire unpaid balance. What Nancy had actually signed, without anyone explaining it plainly, was a personal guarantee, and requiring that signature as a condition of her mother's admission is illegal. Federal law, the same nursing home regulations that govern every Medicare and Medicaid certified facility in the country, explicitly bans a facility from requiring a third party to personally guarantee payment in order to get someone admitted or to keep them there. This isn't a gray area. The Centers for Medicare and Medicaid Services issued new guidance to facility surveyors in late 2024, specifically because this practice was still happening, and enforcement has tightened since. Here's what makes this fee the most dangerous one on this list. The others cost you $15 or $100 or a few hundred. This one has no ceiling. If the facility can enforce that signature, a family member can end up personally liable for a resident's entire unpaid balance, tens of thousands of dollars, for care they never agreed to personally cover. There is a clock here, and it runs backward from the moment you sign. Before you ever pick up that pen, you can ask one direct question. Am I being asked to personally guarantee this resident's payment? If the answer is yes, or if it's vague, you say no. Federal law does not allow them to condition admission on it, and refusing to sign cannot legally be used to deny or delay a bed. If you've already signed something you're not sure about, the same rule still protects you retroactively. A facility cannot enforce a guarantee it was never allowed to require in the first place, and that's worth a call to an elder law attorney or your local long-term care ombudsman before any payment is made. If you're navigating this right now for a parent or a spouse, say so in the comments. You are far from the only one, and the more people who recognize this signature line, the fewer Nancys there'll be next year. If you're on Medicare and you've ever seen a doctor who doesn't participate in Medicare directly, check your next bill against this number. Medicare sets an approved amount for every covered service. A non-participating provider is allowed to charge you more than that approved amount, but only up to a hard ceiling, 115% of what Medicare approved. That's the legal limit, called the limiting charge, and it applies whether the provider mentions it or not. Some states set the cap even lower or ban balance billing entirely. Anything above 115% isn't a gray area or a billing dispute. It's a violation. Here's why this one is so easy to miss. The overcharge doesn't show up as a separate line item labeled illegal fee. It shows up as an ordinary balance due, folded into a total that looks like every other medical bill you've ever paid. There's no red flag on the page. The only way to catch it is to know the 115% number exists and actually do the math against what Medicare approved for that specific service. Walk it through with real numbers, because this is the kind of math that takes 30 seconds and actually protects you. Say Medicare approves $180 for a specific office visit. 115% of that is $207. That's the absolute ceiling a non-participating provider can legally bill you, no matter what their sticker price says. If the bill in your hand says $240, $260, anything past $207, that gap isn't a coding difference or an insurance quirk. It's the exact violation this beat is about. Multiply, don't estimate. A rough guess in your head is how these get missed, and the math itself takes less time than reading this paragraph twice. One caveat, and it matters. A provider who is formally opted out of Medicare altogether can charge whatever they want as long as they disclose it to you in writing before treatment. That's a completely separate legal arrangement. This rule is specifically about non-participating providers who are still inside the Medicare system. The fix takes about 2 minutes. Pull up your Medicare summary notice. It lists the Medicare-approved amount for the service right on the page. Multiply it by 1.15 and compare that number to what you were actually billed. If your bill is higher, call the provider's billing office, cite the limiting charge by name, and ask them to correct it. Most billing errors like this get fixed the moment someone on the other end realizes you know the rule. If you've caught a billing error like this before, or you're going to go check your last Medicare statement right now, let me know in the comments. This is the fastest fee on this list to catch if you know exactly where to look. 7 fees, 6 different industries, 1 repeated design. Every single one of them survives the exact same way. Not because the company thinks you won't fight it, but because it's betting you don't know the specific rule that makes it illegal. Nobody who charged Nancy's family a personal guarantee thought she'd know 42 CFR 483.15 by number. Nobody billing you the pay-to-pay fee expects you to cite the Fair Debt Collection Practices Act back at them. The fee isn't hidden. The rule that bans it is. Which means there's one question, reshaped slightly for each situation, that does the work of all 7. Not, is this fee fair, but which specific law makes this fee illegal, and can you show me you're following it? Ask that question to a debt collector, a bank, a funeral home, a nursing home, a debt settlement company, or a Medicare provider, and you'll get one of 2 answers. Either they correct it on the spot, because now they know, or they can't answer, which tells you everything you need before you pay another cent. If more than one of these applies to your situation right now, here's the order to work through them. Start with whichever one has money already moving. An active garnishment, a bill due this week, a signature you haven't put down yet. Those have a clock. The nursing home guarantee is the only one on this list that runs backward. If you've already signed something, that signature doesn't lock you in the way it feels like it does. And it's worth a call to an elder law attorney or your local long-term care ombudsman before you assume it's final. The other 6 are correctable anytime you catch them. No deadline erases your right to dispute an illegal fee you already paid. And if the phone call doesn't fix it, each of these has a federal agency that actually wants to hear from you. The Consumer Financial Protection Bureau takes complaints on debt collectors, credit repair, and debt settlement. The Federal Trade Commission takes them on funeral homes. The Centers for Medicare and Medicaid Services takes them on balance billing and on nursing homes violating the guarantor rule. And a complaint filed there doesn't just help you. It's part of what gets a facility flagged for the next surveyor visit. So, back to the question this video opened with. Which one have you already paid? For most people watching this, the honest answer is at least one. Maybe the convenience fee on a collections payment. Maybe a bank that took a piece of a Social Security deposit it was never supposed to touch. You don't need to have caught all 7 to get something out of today. You need to catch the one that's sitting in your mailbox right now, or the one waiting in a folder you haven't signed yet. If this helped you spot something, the most useful thing you can do isn't just liking it. It's sending it to the person in your life who's about to sign admission paperwork for a parent, or the one who just got a call from a collector. That's the person this video is actually for, and there's a real chance they see it from you before they see it anywhere else.